From the Great Depression of 1929 to the mortgage crisis of 2008, were there invisible forces behind history's greatest economic collapses. Today, I will show you the dark side of financial markets and the real causes of economic crises. Throughout history, economic crises seem to have emerged suddenly, like natural disasters, but the reality is not that simple. Let's take the 1929 Great Depression as an example. Most people know this crisis as a stock market crash, but in reality, there were years of systematic manipulation behind this crash. The Federal Reserve's interest rate policies, coordinated actions by major investment banks, and the deliberate inflation of speculative bubbles formed the cornerstones of this disaster. At that time, the influence of financial giants like J.P. Morgan on the market was immense. These institutions did not just prioritize their own profits, they also determined how the entire economic system would function. Market manipulation was so widespread that small investors never truly understood the real situation. Information asymmetry was the most powerful tool in the hands of the powerful players. By the late 1922, stock prices were trading far above their true value. However, this was no coincidence. Major financial institutions were constantly promoting the golden age through the media, encouraging people to invest more. During this process, margin trading, buying stocks with borrowed money, was encouraged, and risk management was completely overlooked. The Federal Reserve's role also appeared highly questionable. In 1927, they had lowered interest rates to fuel speculative investments, and then suddenly tightened monetary policy in 1929, driving the markets into collapse. These sudden changes seem to be part of a deliberate strategy, because after the crisis, the same institutions had grown even stronger by purchasing collapsed companies and assets at very low prices. During the Great Depression, approximately 9,000 banks closed, and millions of people lost their jobs. However, what was striking was that some financial giants emerged from this crisis even stronger. Institutions such as Chase National Bank and National City Bank took advantage of their competitors' collapse to increase their market share. This situation provided strong clues that the crisis was actually being used as a tool for consolidation. The economic collapse was turning into an opportunity for the strong to become even stronger. One of the most important actors in modern economic crises is undoubtedly central banks. Since the Federal Reserve was established in 1913, monetary policies have consistently been shaped in favor of certain interest groups. While it is claimed that these institutions operate for the public good, the reality is far more complex. The Federal Reserve System is actually an institution owned by private banks. Regional Fed banks are owned by member banks in their regions, and these banks are directly affected by Fed policies. This creates a structure where conflicts of interest are inevitable. While it may seem unacceptable in a democratic society for an institution with the authority to print money to also represent private interests, this system has been in place for over a century. Quantitative easing policies are one of the most obvious examples of this hidden agenda. After the 2008 crisis, the Fed printed trillions of dollars and injected them into financial markets. However, most of this money did not go to the real economy but to Wall Street. As a result, while stock prices reached record highs, the average citizen's standard of living declined. The rich got richer, while the middle class eroded. The coordinated actions of central banks are also noteworthy. During the 2008 crisis, the Fed, the ECB, the Bank of England, and other major central banks implemented similar policies almost simultaneously. This coordination demonstrates how integrated the global financial system is, while also proving that these institutions are not independent. Institutions like the Bank for International Settlements, BIS, function as secret mechanisms coordinating central bank policies. The most striking example is the oil shocks of the 1972. The petrodollar system was an agreement that directed oil revenues from Saudi Arabia and other oil-producing countries into investments in U.S. banks. This system increased demand for the dollar while also leading to developing countries becoming mired in debt. The Latin American debt crisis, Africa's economic collapse, and Asia's forced adoption of structural adjustment programs were direct consequences of this system. Central banks' interest rate manipulations also follow a systematic pattern. The LIBOR scandal revealed that major banks manipulated interest rates, affecting trillions of dollars in markets. However, this was merely the tip of the iceberg. Daily interest rates, repo markets, and monetary policies are consistently shaped in favor of certain groups. The 2008 mortgage crisis is considered one of the biggest scandals in modern financial history. However, the claim that this crisis was unexpected does not reflect the truth. The foundations of the crisis were laid in the 1992 and were systematically constructed. The repeal of the Glass-Steagall Act in 1999 meant the removal of the wall between commercial and investment banking. This change was not accidental. It was the result of years of lobbying. The growth of the subprime mortgage market was also a planned process. Laws such as the Community Reinvestment Act encouraged banks to lend to low-income individuals while simultaneously laying the groundwork for the securitization of these loans. CDOs, collateralized debt obligations, were complex financial instruments that made it possible to package and sell mortgage loans. The complexity of these instruments was intentional. Investors who did not understand what they were buying were investing in AAA-rated securities. The role of rating agencies such as Moody's, S&P, and Fitch was scandalous. These institutions were assigning the highest ratings to mortgage packages that were clearly flawed. The conflict of interest was clear. These agencies were receiving payments from the banks that issued the financial products they were evaluating. A higher rating meant more revenue. As a result, billions of dollars in toxic assets were marketed as reliable investments. Goldman Sachs' role was particularly suspicious. While selling CDOs to their clients, they were simultaneously taking short positions against these products. Products like Abacus were specifically designed to fail, created in collaboration with hedge fund manager John Paulson. This was a perfect example of maximizing their own profits while defrauding their clients. The Federal Reserve's role also deserves scrutiny. Under Alan Greenspan's leadership, interest rates were kept at historically low levels, fueling the mortgage bubble. When they began raising rates in 2004, millions of people with adjustable-rate mortgages began struggling to make payments. The timing was perfect. The bubble burst just as it had grown large enough. When the crisis erupted, large banks were bailed out under the too-big-to-fail logic, but millions of homeowners lost their homes. The selective rescue or collapse of institutions like AIG, Bear Stearns, and Lehman Brothers demonstrated how controlled this process was. Lehman's collapse seemed to have been deliberately allowed to occur to increase systemic risk and justify larger bailout packages. Ultimately, while Wall Street reaped record profits through QE policies, Main Street experienced a depression. Globalization is not just about the liberalization of trade, but also the consolidation of financial power on a global scale. When the Bretton Woods system collapsed in 1971, the world transitioned to a flexible exchange rate system. This shift meant the strengthening of speculative capital and increased financial instability. Money was now more of a tool for speculation than a means of creating real economic value. The rise of offshore financial centers was a critical part of this process. Places like the Cayman Islands, the British Virgin Islands, and Luxembourg became not only tax havens, but also regions where financial regulations were circumvented. The shadow banking system developed in these regions and reached trillions of dollars in transaction volumes by circumventing traditional banking regulations. This system became so complex that even the Federal Reserve could not fully understand what had collapsed during the 2008 crisis. Developing countries like Turkey are among the biggest victims of these global financial networks. Hot money flows constantly destabilize the economies of these countries. Carry trade transactions are based on the logic of borrowing from low-interest countries and investing in high-interest countries, but these transactions can trigger economic crises when there are sudden outflows. The 1994, 2001, and 2018 crises in Turkey are painful examples of this mechanism. The role of the International Monetary Fund, IMF, and the World Bank is also a subject that deserves critical scrutiny. While these institutions provide assistance to crisis-stricken countries, they also function as tools for imposing neoliberal policies. Structural adjustment programs, the privatization of public services, the dismantling of social security systems, and the opening of markets to foreign capital are integral components of these aid packages. The most striking example is the 1997 Asian crisis. Countries such as Thailand, Indonesia, and South Korea collapsed due to sudden capital outflows. The IMF's prescriptions amounted to completely opening these countries' financial systems to foreign control. As a result, while local banks went bankrupt, foreign banks entered these markets at very low prices. U.S. banks, such as Goldman Sachs and J.P. Morgan, gained access to Asia's most profitable sectors in this way. Derivatives markets are the biggest source of global financial instability. According to data from the Bank for International Settlements, the size of the derivatives market exceeds $600 trillion. This figure is approximately 7 times the world's GDP. Credit default swaps, interest rate swaps, and other derivatives have turned financial markets into a gambling game. These instruments increase systematic risk rather than reducing it, turning small shocks into global crises. The collapse of AIG during the 2008 crisis demonstrated just how dangerous these derivative instruments can be. In the 21st century, financial manipulation has taken on a completely new dimension thanks to technology. High-frequency trading, HFT systems, have developed algorithms capable of executing transactions far beyond human reflexes. These systems exploit arbitrage opportunities at the microsecond level, putting ordinary investors at a disadvantage. Flash crash incidents are proof of how dangerous this technology can be. In the 2010 flash crash, the Dow Jones dropped by 1,000 points in just a few minutes. When one algorithm issued a large sell order, other algorithms automatically began selling in response, creating a domino effect. This event demonstrated that financial markets are no longer under human control. Algorithms have become the most important factor determining market dynamics, but who programmed these algorithms? AI-powered sentiment analysis has become the new tool for social media manipulation. Posts on platforms like Twitter, Reddit, and Facebook are constantly monitored and manipulated by large financial institutions. Bot networks share coordinated positive or negative content about specific stocks or cryptocurrencies to alter market perception. The GameStop incident is a perfect example of how this manipulation is used by both individual investors and institutional players. Dark pools are platforms where large institutional investors conduct their transactions secretly. Over $4 billion in transactions take place in these pools daily, but these transactions are not publicly disclosed. Large players use these platforms to hide the impact they would create on prices in normal markets. However, this system eliminates market transparency and creates an ideal environment for manipulation. Cryptocurrency markets are among the areas where manipulation is most prevalent. Classic manipulation techniques such as pump and dump schemes, wash trading, and spoofing are much easier to implement in cryptocurrency markets where regulation is weak. The suspicious reserve structure of stablecoins like Tether plays a critical role in Bitcoin price manipulation. The collapse of Alameda Research and FTX exposed the extent of manipulation in cryptocurrency markets. Central bank digital currencies, CBDCs, are tools that will give central banks even greater control. Digital currencies mean that all transactions are traceable, which could spell the end of financial freedom. China's digital yuan project aims to integrate the social credit system into the financial system. This is a terrifying example of how authoritarianism can be strengthened through financial tools. The development of quantum computing threatens existing cryptography systems. As large technology companies and governments race to achieve quantum supremacy, it is clear that those who possess this technology will gain absolute superiority in financial markets. The security of blockchain technologies will collapse in the face of quantum computers, threatening the entire crypto ecosystem. During this technological transition period, the advantage of the major powers will increase even further. Radical changes are needed to prevent economic crises and financial manipulation. The current system has become oligarchic, far removed from democratic control, and this situation leads not only to economic instability but also to political instability. Solutions require systemic changes and challenge the existing power structures. First, central banks must be democratized. Institutions like the Federal Reserve must be made accountable to the public, and monetary policies must be determined transparently. As modern monetary theory suggests, the authority to create money should be used to meet social needs, not to enrich Wall Street, but to fuel real economic growth. A financial transaction tax, Tobin tax, should be implemented on a global scale. This tax would deter speculative transactions while also creating an important source of revenue. The proceeds could be used for education, healthcare, and infrastructure investments. Activities that do not create social value, such as high-frequency trading, should be heavily taxed or banned. A modern version of the Glass-Steagall Act must be implemented immediately. Commercial and investment banking should be separated, and depositors' money should not be used for risky speculative transactions. The too-big-to-fail mentality should be abandoned, and large financial institutions should be broken up. Antitrust laws should also be applied to the financial sector, and monopolization should be prevented. Derivatives markets must be subject to strict regulation. All derivative transactions must be recorded in central clearinghouses, and transparency must be ensured. Complex financial instruments that fuel casino capitalism must be banned, and financial markets must be restructured to serve the real economy. The power of technology companies in financial markets must be limited. Algorithmic trading should be subject to strict oversight, and measures should be taken to prevent market manipulation. Social media platforms should be required to develop algorithms that prevent their use for financial manipulation. A global model of financial cooperativism should be developed. Local banks, credit unions, and community development financial institutions should be supported, and financial services should be democratized. Blockchain technology should be used to create truly decentralized financial systems, not for speculative purposes. Financial education should be made mandatory. Citizens should learn how the financial system works, how manipulations are carried out, and how to protect themselves. Media literacy is as important as financial literacy, because manipulation is often carried out in the form of an information war. Finally, international cooperation is necessary. Tax havens must be closed, and offshore financial centers must be regulated. Platforms such as the G20 must be used for genuine global financial reform. However, this requires political will, which will be formed through public awareness and organization. Economic crises are not natural disasters. They are the result of systemic failures and deliberate manipulation. Acknowledging this reality is the first step toward finding solutions. We must act today to leave future generations a more equitable economic system. The shadow banking system has grown even larger since the 2008 crisis, becoming one of the most dangerous elements of the global economy. This system consists of hedge funds, private equity firms, investment trusts, and special-purpose financial vehicles that operate outside traditional banking regulations. According to Financial Stability Board data, the global shadow banking sector is worth $63 trillion. This figure is larger than the GDP of many countries. Asset management companies such as BlackRock are the most powerful players in this parallel system. Managing approximately $10 trillion in assets, BlackRock is not just a company but also a key influencer in global economic policies. The letters from its CEO, Larry Fink, provide directives to company management on ESG, environmental, social, governance issues, thereby shaping the direction of global corporate governance. This effectively bypasses democratic processes. Along with Vanguard and State Street, these three giant companies are among the largest shareholders of nearly all major corporations. They hold decisive power across nearly every sector, from technology giants like Apple, Microsoft, and Amazon to energy companies like ExxonMobil and Chevron. This situation reveals that the free market economy has become an illusion, and in reality, an oligopolistic structure prevails. The private equity sector is the most aggressive branch of shadow banking. Companies like Apollo Global Management, KKR, and Carlyle Group borrow money at low interest rates to acquire companies, then maximize their profits by burdening these companies with debt. This model is known as a leveraged buyout and typically results in layoffs of employees at the acquired companies, wage cuts, and a decline in the quality of services. Hospital chains in the healthcare sector, newspaper companies, and retail giants are being dismantled and exploited in this manner. Repo markets are at the heart of shadow banking. These markets have a daily trading volume of $4–5 trillion. Repurchase agreements are used as short-term borrowing instruments and also serve as the Federal Reserve's mechanism for implementing monetary policy. The short-lived crisis in the repo markets in 2019 demonstrated how fragile this system is. The Fed was forced to inject hundreds of billions of dollars into the repo markets overnight. Money market funds are another shadow banking tool. Although these funds appear to be bank deposits, they are actually securities investments and are not covered by FDIC insurance. The 2008 crisis saw the Reserve Primary Fund break the buck, meaning its net asset value fell below $1, which shook confidence in these funds. However, the system was propped up by government guarantees and has now reached a size of $4 trillion. Structured investment vehicles, SIVs, and collateralized loan obligations, CLOs, are new versions of the CDOs from the 2008 crisis. The CLO market has reached $760 billion and shares the same timing and structural issues. These instruments package low-quality corporate loans into high-rated securities. Rating agencies are once again caught in the same conflict of interest, and history is repeating itself. While the climate crisis is presented as the greatest threat of the 21st century, it is also being used to create new financial manipulation tools. ESG investments, carbon credits, and green bonds have become ways to make huge profits behind the rhetoric of environmentalism. This situation undermines real environmental protection and turns into greenwashing operations. The carbon credit market is one of the largest areas of manipulation. In theory, projects that reduce carbon emissions should generate credits, which are then sold to companies with high emissions. However, in practice, this system largely produces fake credits. Credits are generated under the guise of tree planting projects in the Amazon rainforest, only for the same areas to be later cleared. Palm oil plantations in Indonesia are destroying natural forests under the guise of carbon credit projects. Major investment banks like Goldman Sachs and JP Morgan have become the biggest players in the carbon markets. These banks earn commissions by trading carbon credits while continuing to provide financing to carbon-intensive companies. This double standard demonstrates that financial profit is prioritized over environmental goals. The same institutions that manipulate commodity markets are now applying the same tactics in carbon markets. ESG funds have become a major marketing ploy. While these funds claim to make environmentally friendly and socially responsible investments, their portfolios include fossil fuel companies, arms manufacturers, and corporations that violate human rights. BlackRock's ESG funds are among the largest shareholders of ExxonMobil, yet they claim to be fighting climate change. This situation amounts to the deliberate misinformation of investors. The green bond market is also susceptible to manipulation. Green bonds are debt securities purportedly issued for environmentally friendly projects, but the proceeds from these bonds are often used for unclear projects. Oil giants like Shell and BP issue green bonds to collect money from clean energy investors, but use these revenues to expand fossil fuel infrastructure. These manipulations are easily carried out because third-party verification systems are inadequate. Policies imposed on developing countries under the guise of climate finance have become a new neo-colonial tool. Under the Paris Climate Agreement, wealthy countries have committed to providing climate finance to poorer countries. However, These funds are often provided as loans, with the condition that recipient countries purchase specific technologies. This situation is seen as a strategy to create new markets under the pretext of the climate crisis. Geoengineering projects are the most extreme examples of climate manipulation. Solar radiation management projects supported by Bill Gates aim to block sunlight by spraying chemicals into the atmosphere. These projects could lead to unpredictable consequences by interfering with climate systems and also enable large companies to establish a monopoly over climate technologies. Carbon direct air capture technologies are similarly used as a means to generate profit by selling technological solutions rather than achieving actual emission reductions. The renewable energy sector is also susceptible to financial manipulation. Tesla's stock price is determined more by carbon credit sales and speculative investor activity than by electric vehicle sales. Solar panel and wind turbine manufacturers have become dependent on government incentives, and lobbying activities that influence these incentives are hindering real technological progress. China's dominance in the renewable energy sector is dragging Western countries into new trade wars, and climate goals are turning into a tool for geopolitical competition. As a result, despite the climate crisis being a real and urgent threat, the rhetoric of combating this crisis is being used by major financial institutions to create new profit areas. Real solutions require systemic changes, but the current financial system is preventing these changes from happening and instead offering false solutions that maximize its own profits.